All right, we're going to go ahead and get started. Welcome to the weekly Sonar Market Insights webinar. We do not have a Brad this week, so I'll be riding solo. He had to get called away on another piece of business. So just to jump right in, I've got an item that I don't think we've really covered here in the last few weeks that we released probably in the Sonar 3.2 big release where we changed the UI, upgraded it. This is kind of like where you can get a nice quick market view. So for those of you out there that are interested in kind of, if you're assigned to a specific region and you want to see exactly, you want to have a quick overview of all of our kind of various indices in those certain areas, markets, regions, whatever it is, you can build one of these and tailor it to the exact needs of what your division or your focus is. So I've pulled up kind of a quick example of this with the Los Angeles and Ontario markets. And you can see that I have the head haul index, outbound tender market share, outbound tender reject, and outbound tender volume index pulled up for each one. So each day when I come in, I can kind of check to see which markets are available. You see there's this big black square where there's nothing available. That is simply there because I did not put a haul index value there. And I'm going to walk you through just how to make one of these real fast because I don't really think that we spend enough time making one of these. And I think this is insanely useful, especially for the brokers out there that may be kind of managing a certain area, or the carriers as well, managing certain regions or areas, and they need to know, quickly without kind of jumping into the whole broader picture and sorting through a bunch of watch lists, exactly what's going on. So I'm going to go ahead and just back out of this one right here, close that out and start from new. So you go here and it's called a market table watch list is what it's called. You click on that, and a lot of the times we tell people to go in here and click through the actual, categories here. It's actually more simple if you just know the indices that you're going to want to build and the market you're going to want to tailor this to. So say we're looking to do Atlanta. You're going to click on try Atlanta, hit add. It adds the button there. Okay, I want to add OTVI, ATL. It can be a little cumbersome, but again, if you're only looking at a very specific region or a handful of markets that you're really trying to monitor, I would do this too at a national level. Just to have some of the biggest markets pulled up, I'd recommend doing that just to kind of get a quick heads up, a quick read on the national capacity and volume situation. You can do this, of course, you want to make this as specific or broad as you want. Outbound tender volume BNA, and you'll see exactly what that looks like. I'll go ahead and pull it up. I think you all get the point now. Each one, certainly don't add haul. OTVI.BNA. There we go. Talking and typing, not a thing for me. Save. Oh, and you have to name your list. I do that all the time. I'm going to call this ATL. Now you can hit save, and there is your market table. Of course, you can build these as extensively as you'd like. You can see how easily you can digest a lot of this information without going too deep into each chart or watch list, as I've said in the past. This has been in the product for the last couple of weeks. I think the use case is pretty clear for the people that are managing specific regions or in general the market. I build one looking at the biggest markets in the country just so I can get a quick glimpse of what's going on in the country. Los Angeles, Atlanta, Dallas, Chicago, Philadelphia are in those markets. So again, a nice solid tool to use. In terms of data release this week, we have had a few new things come into play here. We've started diving more deeply into some of our FMCSA data. And I'm going to go ahead and pull that one up through our fleet count. So this is fleet count data, and this is coming from the FMCSA, and it's basically a measure of how many fleets are registered with the FMCSA. We've organized it by size of fleet, so you can see it goes 1 to 6, 7 to 11, 12 to 19, 20 to 100, 101 to 999, just to see how many power unit fleets there are in the registered in the country currently. We are going to do further work with this to kind of shore this up. This is more of the raw number. We're going to do a few more things to this in the future, probably create a new kind of category that allows us to clearly see, how many fleets are actually in there, because one of the weaknesses of this number currently is the fact that this is just a straight general number, and not a lot of maintenance is done in terms of when MC numbers are taken out of the registry. But you see, one of the things that I have gleaned from this is how interesting it is to see how much the number has grown by in the last several months. We do only have 5 months worth of data on this, but kind of breaking this out into, the specific segments, you can see, certain segments have moved in correlation. They all kind of move in correlation, but move this to a relative scale because the number of fleets is quite skewed. You can see they both kind of take this big jump up here in the last month or so. And I find that really interesting. They've grown, if I pulled them all up, to avoid kind of typing and showing you, but they've all grown from about 2 to 6% over the last month in terms of registration. So we can see that there's a high chance or a high likelihood that fleets have actually grown in size over the last couple of months, kind of lagged with the rest of the market itself. It's something that we've kind of anecdotally seen or heard, but we also kind of see it expressed in the data as some of the volume has really not, it hasn't been shrinking over the last little bit, but it has been, we see capacity being more readily available in the market. And in addition to that, we have also added some additional energy or oil volume data down here at the bottom. And these are going to be drilling permits. And one of the things that this is good for, and we're going to be building this data set out a lot more in the future, but for right now, the thing you need to know about drilling permits and approvals is basically how big is the oil industry getting. It is a significant part of the economy and the GDP, and also transportation. There's hundreds of thousands of truckloads involved in the movement of oil as the pipeline still isn't, meeting the needs of the amount of oil production in the country currently. But permits are basically kind of a proxy for exactly how fast it's growing or if it's declining. I'll go ahead and pull up the national drillp.usa, and you can see the permits have actually come down over the last couple of weeks, which is something that isn't that shocking to me, mainly due to the fact that we have kind of hit a point where the WTI or the price of oil is kind of at a good point for people to kind of just maintain. Opening a new oil well creates a lot of, that's a lot of money. They're inefficient at first, and it takes them a while to kind of find that break-even number. As they start producing more and more oil, obviously it becomes better for them to, keep that well open. But for right now, I think the kind of trend, and I'm going to kind of overlay this with the WTI number, just so you can see a quick little relationship between the two. I put this, it is on a relative. So you can see as WTI peaked, we had some oil permits come in, and then it starts to decline, which is going to lead the permit application. So as these people are trying to get oil permit approvals, they're going to see more, obviously they want to produce more oil, but if it's not cost effective for them to build these new oil wells, they're not going to want to submit these permits. Therefore, this is kind of one of those things where we're looking at the oil production to kind of start potentially either plateauing or kind of slowing down, as they're not going to open as many wells. The people do have about a year to fulfill their permits, so they will expire if they don't act on them in a year. So this is kind of a leading indicator in that regard, and what we're expecting to see in the near future with the oil market. We've talked about how there is a big tie to the trucking industry with the oil markets in the past on here, about how, there's a lot of, the traffic in the West Texas Intermediate area, which is the Permian Basin, where all the, a lot of the trucking activity is just clogging the interstates out there. There's so much activity on those roads, and these are typically more conducive jobs to drivers. They get paid a good bit to haul that oil back and forth between there and the Gulf Coast while we wait on the pipeline to expand. So something to keep in mind. And we're going to be starting to build this data set out a lot more. We're going to have a lot more data on kind of the oil industry in general moving forward. But those are the two new indices sitting in Sonar this week, along with the kind of the watch list. I just kind of want to go through those in brief, and then we can start to kind of break down what we're seeing in the country in general. Without Brad here to kind of give me my cues, I'll just go ahead and have witty banter with myself. So over the last week, we really talked about how, Los Angeles has been a huge market in terms of driving the overall volume in the country. We started to see the Los Angeles market really deteriorate over the last week or so. I'm going to pull that one up on a chart. On the left is the outbound tender market share watch list. For those of you that have not seen this, it is a watch list that is telling us the relative size of the markets organized from top left to bottom right. And the largest markets are going to have the biggest real estate in this thing. And the smallest markets are going to be sitting down here where you can't see them, but you can hover over them and see exactly what they are. These percentage numbers right here are the day over day changes in percent. And these big numbers right here are the total percent of market share. So the whole pie, if you added all these up, these little numbers right here would add up to 100. That would not be the case for these smaller numbers up here. They are legitimately just measuring the day over day change. So Los Angeles, as we pull up our Los Angeles chart, you can see right here, and I'm going to zoom in a little bit more so you can see, we've been averaging about 13% higher volume coming out of Los Angeles. And for those of you that don't know, there's a huge port sitting in Los Angeles, and it governs the majority of the inbound container freight into the United States. Los Angeles and Long Beach account for a huge chunk of that percentage, along with Newark on the other side of the country, but that is a different story altogether. For freight movements, the Los Angeles ports are typically more important to watch in terms of container movement, because a lot of that freight hops off of the port and then gets on some sort of surface transport via rail or truck. And this volume has really been driving up our tender volume index number over the last, I'd say, 2 to 3 months. And I'm going to go ahead and close the outbound tender market share chart out just to show you. Typically, if we overlaid the outbound tender volume USA chart over the top of this, the peak of that, and I'll pull that up in a minute, is in June and July. Los Angeles kept growing throughout the fall as the inbound container freight basically flooded the ports. They had record volumes. And then they started kind of transloading it and moving it throughout the first quarter of this year as they've tried to find new warehouse space. Over the last week, that volume has dropped significantly. And it was kind of led by our handy FreightWaves Baltic Index, and that measures the rate, the average spot container freight rate for a 40-foot unit over coming from China to North America's West Coast. Get that pulled up. There we go. If I can pull that up, and not in dots, but in a line. Anyway, you'll see that the FreightWaves rate has dropped and continue to drop, and it kind of mirrors the container freight in the out of the port in Los Angeles. So the outbound volume in Los Angeles has drastically been impacted by all this inbound container flow. And we have mentioned that Northern California has been the destination point. Moving on from that, we are also seeing the United States volume picked up early on in the month. We thought this might be the big breaking point for the rest of the market to kind of start turning up and heating up. And it really kind of fizzled here in the last couple of days. So the outbound tender volume index measures it's an index that measures freight volumes in the country. And when this thing goes up, that's a good sign for volume in the country. When it goes down, volume goes down. So we were about 10% higher at peak volumes in the month of June. Right now, we're sitting at about 3% lower, 3 to 4% lower than we were this time last year. Now, this is one of the first times that we've seen a pretty decent drop in year-over-year volume in the United States. So all the kind of macroeconomic indicators that we've talked about moving forward have really had, kind of the positive consumer momentum that we had coming out of 2018 has started to look like it might be fizzling just a little bit. But the market itself, volumes are starting to weaken a little bit year over year. And one of the ways that you can see this really easily is pulling up the OTVIY. And that's going to give you an easy way to see percentage-wise just where we're at in a year-over-year basis now that we have actually crossed over the year-over-year point. And this is only going to be a few days old or a few weeks old because we just literally crossed it right now. Anything in the red right here is basically saying we are underneath where we were last year. Anything in the green, as we came out on fire out of the gate in March, is going to say we were about 1.5% higher than this time last year. But right now we're sitting around probably 4% less than we were this time last year on the United States tender volume. What does that mean in terms of capacity is probably the best question. As we go through the, volume does not always mean that capacity is impacted at the same time. Market balance is actually the key, and that's kind of what we measure in SONAR. A lot of these, other indices are simply there to kind of add color and reason as to why the market is, whether we're seeing, rate pressure go up or down. The tender rejection index has probably the most near-time relationship with rate pressure in the market. And as these rates kind of fall down and stay flat, they don't even have to really go down. They just have to stay kind of flat to kind of allow the market to be in balance. Rates fall even when the tender rejection index goes flat. And right now it's been pretty flat, but it has been starting to really fall back down again after the first of the month. What this is going to mean is that outbound rates are going to probably come down as well as we move further into the month of March. We don't see any indication that, volumes are going to really surge or spike in the near term. That could still happen as we move into the middle of March, which is more, you could, especially with the weather patterns that we're seeing right now, a lot of those, once those weather patterns start to break down and we get some of that thawing going on, you're going to see a little bit more activity. How much of that activity stays with us has yet to be seen, but right now the market is really soft and really flat. We're thinking that rates are probably going to continue to be so here in the near term moving forward. So to kind of highlight a few other indices that we've put in here over the last week, kind of give a quick recap. We added detention minutes, or not detention, I mean the wait times, I should say, as well as some new mileage information. I can locate that in here. So the detention information, we actually noticed had a big correlation with, I'm just going to put it in here, volumes kind of falling down and the market kind of falling down on us. And actually, I'm going to do that with the tender rejections. As wait minutes have increased, we've seen the market kind of subside. So shippers in the country are now actually looking at the market. It looks like their behavior patterns have changed quite a bit. As the market's kind of stabilized, rate pressure has fallen down. They are less concerned about, managing their docks. Their wait times have increased upwards of 25%. Tender rejections have fallen 73% since this time last year. So some behavior patterns to check out. I just wanted to remind everybody that we do have other things in here. When you're negotiating rates out there, know that shippers do have some indication of what's going on in the broader market as their behavior is actually represented in some of these indices out here. Detention minutes is one of those, as well as tender lead times. Their tender lead time tends to get smaller as they have more options in terms of shipping. As we've seen here in February and January, when the lead times get lower, it means that they're less concerned about what's going on in the overall market. Something to watch moving forward. You can see some of these lead times start to pick up here in the beginning of March. We simply think that that has more to do with they're expecting a lot of surging volume, so therefore they're changing their behavior a little bit, saying, okay, we've got to get some more freight out, give them a little bit more heads up. But it's also kind of a good sign in the way that they might be thinking or having some sort of forecasting about how much lead time is in the overall needed and to secure capacity in the overall market. So that is about all I wanted to cover today in terms of new information and kind of give a quick recap. The market table is probably one of my favorite things to use. I'd highly recommend it to the specifically carriers and brokers out there, but the shippers as well, any of our shipper users, they'll obviously have a very static kind of market table to build if they wanted to look at things in their specific areas. If they have DCs or facilities sitting in New York or Atlanta or whatever the city may be, they can set up those tables to specifically monitor any kind of emerging situation that they might have over the course of the year. And that'll be a quick way for them to see clearly right away what they need to do and prioritize in their day. So with no Brad here this week, I'll go offline for just a minute and wait for any questions that come through. And if not, you guys have a good week. Thanks. All right, looks like there's no questions this week. So everybody have a great week and we'll see you next time or next week. Oh, we do have one question. So the question is, with the detention time, is that based on requested detention or actual wait times? We are seeing an increase in requested detention. So yes, it is based on actual wait times. It is not a true detention time, if you will. So because many carriers have their own definition of detention or free time, LTL carriers will give traditionally about 30 to 45 minutes of load unload time, whereas your truckload carriers will have an hour and a half to 2 hours of free time. So those are straight detention minutes, or straight wait time minutes, I should say, while they're getting loaded or unloaded. So it's the total dock time. And we have also taken out anything that lasts, over a day. So the drop trailers and anything like that are taken out of that data entirely. Good deal. So again, thanks for everybody for tuning in, and we will talk to you again next week at the same time.